Welcome to 2023 Winning in Retirement Classroom Session. It's straight from our Forest Hills recording studio. I'm Brian Akers, I'm CFP and President and Founder of Akers Financial Group. Today we're going to have Mark DiOrio from Brookstone Capital Management. Brookstone Capital Management is one of our third-party money managers that we use out of Chicago. And Mark actually does manage some of the portfolios of our clients. Also today, Alex Monk, one of the heads of our investment committee, will be speaking about the market in review and also about the outlook for this year, 2022. Make sure you understand our disclosures about our broker-dealer, Akers Capital, and Akers Wealth, which is a registered investment advisory firm. And we're serving this as general information that we then highly recommend you sit down with your advisor to go over how to apply this to your portfolio. Now, as we go through this, make sure you realize there's a chat button on the bottom, and we'll have somebody watch it over the webinar as you watch it, and you'll be able to chat with us and ask questions. And if you have any questions, be in touch with us. Thank you very much and enjoy our classroom session. Hey, at this time, we welcome Mark DiOrio from Brookstone Capital Management. Good morning, Mark.
Good morning, Brian. How are you?
I'm glad to have you here on our talk today. I look forward to hearing your market outlook and a little bit more information about Brookstone. So tell me a little bit about yourself before we get going on your presentation today.
Sure. I'm the Chief Investment Officer of Brookstone Capital Management. We run and manage about $8 billion under management. As a way of background, I started in the business over 20 years ago, went through the tech boom and bust in the late 90s and then the early 2000s, and then managed money through the global financial crisis, 08 and 09, and now kind of fast forward up to the point where we're going through this current crisis, kind of a COVID environment, now a post-COVID environment, if you will. And so I've been the Chief Investment Officer for about 8 years. Prior to that, I was a Chief Investment Officer for a boutique investment advisory firm that was a subsidiary of a publicly traded regional bank holding company for about 7 years. And then as you'd expect, prior to that, I kind of came up through the ranks. You start in research generally in this business and go the research and then what they call portfolio management, where you're making individual security selection decisions on either stocks or bonds or asset classes. And so I've held many roles on what they call the asset management and portfolio management side of the business.
Yeah, we do appreciate that. I know at Brookstone Capital Management, we've used the Brookstone Capital Management as our third-party money manager this coming year is 10 years now, which is excellent. And so we look forward to your presentation today. Won't you gear up those computers and let's get going, Mark.
Let's do it.
All right.
Well, hold on. Let me pull up my presentation.
I love when technology works. And here's Mark DiOrio. All right.
Thank you. So this is the first quarter market outlook, and I'll just jump right in. I have a number of slides, but last year was a really difficult year for stock investors. As a general rule of thumb, a decline of between 0 and 10% from a market high would be considered a market pullback. So if you hear that term, pullback, 0 to 10%, decline between a negative 10 and a negative 20% would be considered a market correction. So if you hear that term, that's what they mean by market correction. And a decline of more than 20% is really considered a bear market. So last year, all the way to the right-hand side, the market declined about 25% at its worst point top to bottom during the year. What this chart reflects is the gray bars reflect the year's return. And this goes back to 1980. So the full year return for the S&P 500. Those red dots there show the maximum decline during that year. The average is about 14%. So you can actually expect a market correction to come out for a variety of different reasons on any one given year. Now, we don't always have a 14% correction, and some years are just single-digit type declines, just a little bit of movement in the marketplace. But last year, we definitely went down that bear market path, down more than 20%, and we finished the year down 19%. So it's pretty normal for stocks to be fairly volatile and have these drawdowns in pursuit of higher returns over time. So stocks have traditionally more volatility than bonds. But what was different last year in particular was that what are considered more conservative investments or bonds were actually down double digits as well. And this is the same chart as the prior page, except this is using the aggregate bond index and going back This is the first time that the aggregate bond index has actually declined in double digits during the year, and then also finished the year down double digits. So at its worst point, it was down 17%, almost the equivalent of a bear market in stocks. And finished the year down 13%. So investors that thought they might have been more conservative and had more bonds in their portfolio really didn't get that conservative type of return profile. And a lot of clients that balance their portfolio, maybe half stocks, half bonds, really didn't get a lot of defensive action or positive action from bonds. They were down almost as much as stocks. So it was a very challenging year for both stock and bond investors. So that was pretty rare. In fact, this scatter plot, I know there's a lot of data points here, but this is the stock and bond returns over the last 100 years. There's been, including last year, 6 of those years have had both stocks and bonds decline. So it's a pretty rare occurrence. And this is the first year that both stocks and bonds were down in the same year more than double digits. So this is a pretty rare event and a very challenging year for sure. And I think a lot of that had to do with the Federal Reserve raising interest rates at the fastest pace in 40 years. And so the Federal Reserve is the central bank of the US, and they set interest rate policy. So what they technically set is the Fed funds rate, which is the overnight rate that banks lend to each other. So if you hear the Fed is raising rates, they're actually trying to slow down the economy, slow down inflation. They're making it more expensive to borrow. But what they're technically raising is the Fed funds rate. And this is normal for banks to lend in the overnight market because banks have required reserves that they have to keep on hand. And so this is a normal part of the business, but the Fed kind of enforces what rates those banks can charge and then what price that would be at. So when they lower interest rates, they're trying to stimulate the economy. They really have a dual mandate. The first mandate is to promote policies that encourage full or maximum employment. And by rule of thumb, they mean try to get unemployment levels to about 5%. So that's a primary role. And then another primary role as part of their dual mandate, which they have to balance, is to maintain moderate prices. So that's essentially saying have to keep inflation or the general rise in prices. Historically, that's meant between 2 and 3%. And so they're balancing these two. And sometimes those policies are at odds. Sometimes you want to, during the COVID phase when we had the shutdowns and they closed businesses and borders, they reduced interest rates very aggressively, put in some stimulus efforts to help with the dislocation in the jobs market. Now that we're entering this kind of post-COVID world where you've reversed that, and now you have this inflation leftover issue, and employment is actually at 50-year, or unemployment is at 50-year lows. So that's no longer the primary concern. Now it's shifted over to this dual primary concern, or the other primary concern, which is managing moderate prices to get a hold of inflation. So they raised rates at the fastest pace. And for reference, for those that might not know, when you raise interest rates and bond prices are inversely related. So when you raise interest rates, bond prices decline, and vice versa. Now they did this because you had essentially an outbreak in inflation that's 40 years old. You haven't had this type of outbreak inflation on a broad basis in 40 years. So they really were aggressive at raising interest rates to try to stem off or slow down the economy and slow down demand to slow down inflation overall. So that's really what they were addressing and why they were addressing it and being so aggressive. Now, one of the offshoots of this is, if you think about what inflation is, it's the general loss of purchasing power of your dollar. Well, the US dollar on a purchasing power parity basis actually rallied very strongly against other currencies. So when I think about inflation, it's a relative, and the value of your dollar, it's a relative game. And so it's relative to what? Did it lose money or purchasing power relative to what? Well, relative to the euro or the pound or the yen, it actually gained a lot of value. And so you had this really big rally in the US dollar. And in fact, what this chart is trying to argue is to say, well, it rallied so much that it's trading well above its purchasing power parity basis, or where it normally would be trading at. And why that's important for investors is the US dollar is the one asset class that has a negative correlation to all major asset classes. So whether it's high yield bonds, traditional bonds, emerging market stocks, large cap stocks, small cap stocks, it's inversely related. So when the US dollar rallies, that can be a real headwind for financial assets, and gold as well, which is a big inverse correlation to the US dollar. So that really had pressure on financial assets. Now we think that that's poised to start to reverse as we head into 2023, since the market really overshot on the upside. And then from a stock perspective, although the historical precedent is limited, we do like to look at market history. And the 5 other times where both stocks and bonds were down in the same year, the following year had some pretty good returns. For the S&P 500, the following year return was 17.6%, and for the following year for bonds, 7.4%. So it really clawed back a lot of those losses in the following year. So do we have reason, when I look at this, we always want to say, well, that's history, but do we have reason to believe that history could repeat or be supportive of asset prices going forward to have that type of outcome? Well, I mentioned the main reason for the Federal Reserve to raise interest rates, or really be tighten monetary policy, as it's called, is because inflation continued to rise throughout the year. And then all of a sudden, as we hit the fourth quarter of the year and really the tail end of 2022 and the first part of this 2023, inflation now has actually started to tick lower. And so we continue to get positive news on the inflation front, meaning the rate of change is declining and starting to head back lower. And historically, from inflation spikes, they typically come down at about the same pace. So we'll see if that holds true, but we've definitely gotten positive signs. So if inflation is starting to come down, that the Federal Reserve will lose really the reason to continue to raise rates, because it doesn't want to just raise rates infinite. It's going to raise rates to the level where inflation comes down and that the economy can handle. And one good look at inflation concerns is looking at the price of oil. Oil today is trading right around its 20-year average. So while we had a big geopolitical spike earlier in the year of 2022, prices have really come down. And I don't think prices are all that concerning. Nobody likes elevated prices at the pump, but I think with oil trading right around its 20-year average, I don't think we have that much to complain about. It just happens to be a necessity at this point, but I don't think it's going to be a headwind at this point. In fact, from an inflation standpoint, the rate of change of oil, so it's not just the level, it's also the rate of change, how quickly prices are going up or down so that the economy and consumers can adjust to those prices. Well, we had this spike last year, which was very quick, so that kind of shook the economy and the consumer for sure. And we saw that in the consumer numbers. Consumer confidence really dropped when you had this big spike in oil prices because it's more expensive at the pump. However, now, the last 6 months, we've seen a rate of change in the price of oil of a negative 24%. So that decline in prices is going to start to show up in those inflation numbers, and the energy component has actually already started to tick down, the energy component of inflation. So that's actually a pretty good positive tailwind for these inflation numbers coming down and getting to a comfortable range. For a long time, or at least the last year and a half, economists have been espousing the idea that in order to get a hold of inflation, and this is kind of the consensus view, in order to get a hold of inflation, the Federal Reserve would have to raise rates enough to drive the economy into a recession. And so recession expectations have gone up through the roof. They're at 60-year highs. It's now well known or well expected that a recession is going to happen. So we go from an inflation spike to a recession. So inflation 2022, which spooked the markets, and then recession 2023, which kind of compounded the challenges. And that's why stocks and bonds both couldn't really get anything together in 2022. However, when we look at charts like this, what could be the surprise that actually surprises market forecasters and that what the market could do? And I'm sympathetic to the idea that we could get a recession. Most of the traditional recession indicators are telling you, well, you have tight monetary policy. Leading economic indicators are heading lower. The Treasury yield curve, something kind of in the weeds, if you will, is also given a signal that a recession typically follows when you see short-term interest rates higher than longer-term interest rates. But it doesn't really narrow down what the time frame for that was. But all those indicators that have historically led to kind of a recession are showing. However, the one thing that I think is the surprise for markets is that a recession may be coming, except it's not here yet. So the market has started to anticipate a recession, and it just hasn't shown up yet. And in fact, the Atlanta Fed GDP Now numbers, which they compile kind of on-demand numbers on a daily basis and post expected GDP or economic growth, is showing 3 to 4% economic growth, nowhere near negative numbers. And recession is considered 2 negative quarters of GDP growth. And so what this is telling us is, well, wait a minute, maybe the economy can handle higher rates. Now, if you go too high on rates, it gets really challenging because you're tightening too much monetary policy. But this is definitely saying that the economy is not just rolling over just because those secondary signals are all telling you that we should go into a recession. The economy is actually very resilient here and managing higher rates. And the key, I think the key data point and a primary data point for recession would be the unemployment rate. You'd have to have unemployment rising to higher levels to get a recession. Well, today we're at 50-year lows, around 3.5% unemployment, where 6.2% is the 50-year average. And wage growth as well is not running away. It's actually coming back into its 50-year average. So wage pressures aren't like the 1970s wage price spiral, that an inflation spiral that economists are concerned about. Wages have come down while or come down into a reasonable range, so they're still growing while you have unemployment very low. And so this is telling you that the economy is handling these higher interest rates very well. And so this is telling us that this might push out the recession further than the market expects. In other words, the market was expecting us to be in recession today and kind of last through about 9 months, let's say. And it just isn't here yet. And so this is pretty positive, and this could be a big surprise. So if you have inflation coming down, you don't really need to raise rates all that much any longer. And this is a chart of the yield curve. This is the Treasury yield curve, the rate that the government borrows at, treasuries. And so it goes from left to right. You go from the 3-month to the 1 year, 2 year, 3 year, out to 30 years. What rate are treasuries trading at? And the light blue bar at the bottom, or line at the bottom, is where we started the year. So very low. And now where we're at 15-year highs, essentially. And interesting about this chart, it's called an inverted yield curve. It's where these short-term rates on the left-hand side, the 1 year, the 2 year showing that 4.7, 4.4 range. And then as you go out longer term to the 10-year 3.8 and then the 30-year 3.9, they're trading below short-term rates. So this is an inverted yield curve, fairly rare. It does suggest that monetary conditions are tight out there and historically suggested a recession. But either way, we think we're at these 15-year highs, and there's not a lot of reason to go much higher if inflation, in fact, is coming down. So one of the positive news for bonds is that, well, starting interest rates are higher, and your forward return on bonds is linked to your starting interest rate. So this nice coupon coming in is something, this, let's say, just for ballpark, in that 4% range on an aggregate bond index, on a general bond portfolio, is a good starting point. Whereas last year, coming into the year, that coupon was about 1.25%, very low. So you're starting with a much higher income level coming in. In fact, when we look at bonds and we do a general rate shock, this is saying that, well, what would happen to the bond portfolio if interest rates rise 1% or if interest rates decrease 1%? So remember, bond prices move inverse related to interest rates. So if bond prices rise 1%, the bond portfolio would be down about 2% for the year. However, if interest rates decline 1%, bond portfolios would be up over 10% for the year. So you have this asymmetrical risk profile developing in bonds. It really gives you that kind of a 10% on the upside, 2% on the downside type scenario that looks pretty good. But either way, you're starting with this 4% coupon coming into the year. And then flipping over to stocks entering the year, well, everyone knows prices. You can search anywhere to get a price for Apple or Microsoft or the market in general. But it's harder to know what's the fundamental fair value for those stocks. Well, we use Morningstar's estimate of fair value. They have a large coverage universe, and this is what they call a bottoms-up or fundamental approach to valuing stocks. Now, it doesn't tell you that it's going to turn and go to that certain price at a level at any point in time. You need some type of catalyst. But what we do know, and just looking at this chart, taking that universe and saying, where are most of the stocks trading? As a group, they're trading about 16% below their estimated fair value. So, coming into the year, that stocks are undervalued relative to their fundamental fair value. Now, the fundamental fair value does not take into account all the macro challenges, kind of the headwinds that we're facing. But I think part of what we're looking at is, well, those are starting to dissipate. Those were 2022's issues, not necessarily 2023 issues. So now we come into the year where bonds look favorable and now stocks starting to look favorable. They just need some type of catalyst. And it could be that news isn't as bad as expected, such as, well, the recession isn't here and it may be pushed out a little bit further than the market expects. And when news isn't as bad as expected, that can be enough to raise prices and expectations. So last several times that prices were at this level, there has been ultimately has led to nice gains for equity holders that are patient. And another piece of kind of interesting tidbit is there's never been a recession in the first 6 months of the third year of the presidential cycle. And so we're in the third year of the presidential cycle. Why that's important is because historically, that's been actually the best year of the 4-year presidential cycle. People find that interesting. And I think it is interesting because the business cycles almost started to coincide with the presidential cycle. And so the third year historically has been the best year. And this is a cycle composite that looks at the 1-year cycle, that 4-year cycle, and then a 10-year cycle. And it just gives you this nice composite kind of to look at how the market could go based on history. And it does generally show a rising market for much of the year. And so I think it has that influence of that third year of the presidential cycle to it. So it's something to keep in mind and watch. And what we do is just gauge this as an idea and see if there's any reason to deviate or support this kind of idea that the market can go and has some positive historical backdrops to it. Last year, tech stocks or growth stocks really got hit hard, and these are some of the largest companies in the market, got hit hard and led the market lower. So tech stocks really got hit hard. Small cap, mid cap, large cap, they all got hit very hard relative to traditional value stocks. But the performance deviation was so great that I think you're at a very oversold position for growth. And this is kind of a chart we look at for reversion to the mean. What's overbought relative to the other one? What's oversold relative to the other one? And then you take the other side and you can kind of see if you get a catch-up phase. This looks like we're at a potential at some point, if there's some catalyst where you could have that nice mean reversion where growth or tech stocks have a bounce back in relative terms to value. International stocks is another area. Well, I mentioned we had a strong dollar. Well, this year, if we have a general weakening or declining US dollar value, which would be normal, which would loosen monetary conditions, you could see international stocks start to bounce back. Already, they're trading at about 30% discount to US stocks, which is historically a pretty wide margin. And US stocks have outperformed for much of the last decade or so. Anyway, so there is some catch up to be done as well. And dividend yields in stocks, in international stocks are also quite high. So that's just adding for the kind of the fundamental case that you could get some international catch-up phase occurring. Now, this is another cycle chart, which in the blue line, it suggests that, okay, well, what if we bottomed last year, the fourth quarter of last year, in blue here, and that's the dotted line, and the market has just started to kind of recover and climb back. And then there's no recession develops, and it just keeps grinding higher, kind of climbing that wall of worrying about a recession. Well, that's the wall of worry a market could climb. But what if a recession is here? It's hitting right now in the first quarter. That's the orange line here. And what's interesting about this chart is that, and it shows basically a recession for 2023. Even if you have a recession, the market ends up by the end of the year right about where it would in a non-recession scenario, just a different path. So the market would go lower if a recession hits here, but it would ultimately turn around about halfway through the recession, which is normal, and start to head higher. So the market starts to discount, it moves very quick to the downside, but then before the recession is over, it ultimately bottoms and then starts a steep ascent, expecting better times to come. All the bad news is out, and it anticipates growth going forward. So although the paths are different, this is a very interesting chart from the sense that you don't want to make rash investment decisions just based on a singular scenario, whether it's just a recession scenario, and kind of get spooked out of the market, because before too long, it can turn around and turn on a dime and just start to head higher much quicker, well before the news starts to become good or positive or supportive. So I thought I'd leave kind of this chart as the final slide, and then bring you back, Brian, if you wanted to add any comments.
Well, I was thinking the outlook actually sounded pretty positive based on everything you were saying to us.
Yeah, I think much better than the headlines. I mean, the two headlines that people have probably heard for the last 2 years are inflation, definitely last year, and then recession and that concern. And what I'm I think trying to say is that markets already moved to the downside pretty good in 2022, anticipating some inflation challenges and then some recession challenges. However, the recession part just hasn't come up, and there's positive news on the inflation side, which could lend support to it. So I think that's important to know just how challenging last year was, but also that I think there's a lot of positive catalysts or stories or support to the market overall.
What's your opinion on inflation, where it is today, and where it should be heading short and long term?
Yeah, I think in the short term, I think it's coming down fairly quickly, and we're going to continue to get positive news on that front. I think some of the demand has now dissipated from kind of the reopening, and some of the delays, whether it was building or whatever delays that were occurring, has now also dissipated. So that pressure is going to come off those prices. Also, what we're seeing is shipping rates are at pre-pandemic levels. You're starting to see used car prices come back down. So you do have a little bit of demand declining, and also just general supply chain issues alleviating. So in the short term, I see that coming down. Now, you make an interesting point of not just looking at the short term, looking at the longer term. I do see that, and this is an important point. I do see inflation coming down short term, but then longer term, it's going to remain elevated, higher than we've experienced over the last 10 years in that very low level, a little bit below 2%, but I do see it higher. And it's one of the reasons why you build an investment portfolio, is to protect your purchasing power over time and grow that purchasing power over time as well. And that's why you're putting together the investment portfolio. Sometimes we forget about that in the day-to-day noise and the ups and downs of the market, but inflation will still be with us. And I think it's going to be at a little bit higher rate, probably closer to that 3 to 4% range going forward on a long-term basis. So after you have this decline, then it'll find its regular level.
Yeah, absolutely. Well, Mark, we do thank you for your outlook and for coming on our classroom talk today. We appreciate that. Do a good job for all of our clients this year. We look forward to having you at our event later in October. Thanks very much, Mark DiOrio.
Looking forward to it. Thanks, Brian.
Hello.
My name is Alex Monk. I am a certified financial planner here at Akers Financial Group, and I am a member of the investment committee. I actually head up the investment committee with my co-chair, Bernie McVeigh, and the other two members are Brian Akers and Jeff Akers. I want to say thank you to Mark DiOrio for joining us today and bringing his brilliance and all the tools that they have there at Brookstone. They really have been a great partner for us over the years. I'm going to jump right into our market outlook and a review of kind of what's happened in our AFG Select models here. First, we got to touch on some disclosures. I hope everyone's memorized it. We will be testing you at the end. So first, we're going to start with our AFG Select portfolios. So at Brookstone Capital Management, we have what's called AFG Select models, where in-house we design 4 different models to accomplish different things, and we'll touch on each one of those here. So the first one I want to highlight is the income model. Now, we heard Mark talk about bonds being down, and it's kind of an odd year for that to happen. And typically at Akers, we do not hold a ton of bonds. We use fixed or fixed index annuities as a bond replacement. And this year was a great example of why. Now, our income model is geared toward generating current income or cash flow off the portfolio for those that are in that stage of life. So to prevent some of the downside that we had in bonds, we have active management in there, and we have some low volatility names, some blends of different type of assets that are going to move slightly different than your traditional bond index. So the income model for 2022 was down 9%. It's about where the Dow was, and it's a little bit less than what the aggregate bond index was down, which was 13%. So we're happy with that. We do not want to do all the downside of whatever our benchmark is. Our next portfolio is the moderate portfolio. It has its main goal is to be a core holding, a well-diversified blend of different asset classes, blending passive and active without taking any extremely risky overweight bets to one sector or the other. Our moderate model over the last year was down 13.29. So that is less than the S&P 500, and that is what our goal is. So we always want to go down less than whatever the market that we're following is. And here we were able to do that through using some active management as well as diversification. Our next model is the moderate aggressive. Now, this model has some overweight exposure to some high beta names or some riskier assets, which in this case would be tech stocks. So if you look at the NASDAQ over the past year, it was down around 30% almost. Our moderate aggressive would compare, it would be more of a blend between the S&P 500 and the NASDAQ. Then the moderate aggressive for 2022 was down 17.25%. So not only were we down less than the NASDAQ by far, we were still down less than the S&P was, which is our goal. So we're taking, in theory, more risk, or we're taking less risk than those two market indices to achieve the same type of returns on the upside, but with limiting the downside. And our last model is the diversifier. So the diversifier is meant to be added on to kind of a core holding. It's there to add in asset classes that you're not going to find in your typical portfolio, which is going to be a lot of gold, a lot of silver, some real estate, some commodities. And we're going to have some values, international value stocks there, which you typically don't see a lot in a ton of models because they're a tough asset class. Now the diversifier shined the brightest this year. It was only down 4.6%. I really thought gold would have had a better year, but when you have monetary policy and you have some currency things going on, sometimes gold can lag or can have some different impacts and not move exactly the way that we thought it would correlation wise. Although here being, almost a month into month and a half or so into 2023, we're starting to see gold pick up. So that trade is starting to work again. So the old school gold safety trade is back. The diversifier over the past year was down 4.6%. And that's what we're looking for. We want to do something different than what the market does. So having that little portfolio add-on there to get us a well-diversified overall top-down asset allocation really helps when things get a little volatile, because we're not going to do all the downside if we don't have all the exposure. Now, this year we did make some portfolio changes. In summer 22, we added healthcare, consumer staples, and utility exposure to the moderate model. So this is considered a defensive move, in that we are supposed to be going into a recession, or we're in a recession, whatever they're going to call it. We knew things were going to be volatile with rates going up, coming out of a COVID boom, supply chain issues, just so many things going on. And our main goal still for the portfolio is to hedge against inflation or protect purchasing power. So we focus on shareholder yield, dividends, commodities, metals, and the general idea of diversification. This past year was such a good example of why you need to be diversified. When everything seems to be going down, you have to have something that's not, or is going to move slightly differently. So for 2023, Mark covered a lot of similar points on how we think things are going to go. So we're coming out of a correction year. And this could be a year where we normalize to long-term growth rates that are typical for the market, but I still think we have some things that we have to process. And the biggest thing right now would be monetary policy. So the Fed is really trying to stop inflation, and they're going to use all the tricks they have in their bag to do so. The tough thing will be, when do they ease versus how long are they going to be restrictive? It's a tight line to walk. Having all these things is going to create volatility, and we're going to see some names go up, some names go down that could be in the same benchmark. So you could have two stocks that are in the Dow. One could be way up, one could be way down, just based on how different things are moving in the market. Inflation is a huge thing. I mean, everyone felt it. Everyone knows how much things are costing. It's a tough thing to deal with. So we have to go through some of this pain of these rising interest rates in order to get things to slow down to a point where we're not going to get ahead of ourselves. And I know when we're going through it, it's not a lot of fun, but in the long term, these types of resets or these monetary policy moves can be very good for the market in a longer term outlook. Some of the headwinds we might have this year: geopolitical events. We have, who knows what's going on in Russia and Ukraine. That's a never ending thing, but it can impact commodity prices. It can impact international stocks. It can impact US stocks, depending on what happens and who's involved. We still have COVID variants. I don't know if that's ever going to go away. We're still dealing with the supply chain issues, and they're popping up, and they're strange. It's not an easy fix when you shut down the world for 2 years, and I think it's going to be a while as we process these things. The recession fears. That's all we've been hearing about in the news. So sometimes that can be almost like a self-fulfilling prophecy. And then we have labor shortages. It's a different type of recession out there. In my opinion, it's more of a price recession. Inflation makes everything more expensive, so you're not able to purchase as much for the same dollar. So while things, earnings may look like they're going up, expenses are going up twofold. So cost of materials, things like that. That's a little bit different because it's not going to impact the GDP the same way that it always does. But everyone's feeling it in their pocketbook, that's for sure. And the interest rate hikes. That's a big one too. We don't know when the Fed's going to ease. We don't know how long they're going to raise rates. We're thinking that, now that inflation is starting to show signs of easing, that the Fed will slow down on raising rates or keep rates kind of where they are. But, again, we don't know what they're going to do, so we have to be prepared either way. And then we have labor shortages. It just seems like we can't find enough workers. So however we have to go about doing that, eventually people will return back to the labor market, but that's going to take time. It would take, a bunch of different avenues to get that one worked out. Our overall playbook for this year, again, number one, diversification. We want to review our asset allocation from an overall standpoint. Times of volatility like these can be good times to buy. Now, that being said, if you don't have cash to buy, that means you have to make changes somewhere else. So we always want to have that balance. And that's what our goal is for our clients here at Akers, is never be in a forced sell situation, always be a buyer when things are low, always be a seller when things are high. And in order to do that, you have to be diversified. Hard assets, they are going to do very well in inflationary times. Commodities, real estate, precious metals, they typically outperform because they're a limited source asset. You can touch it, and it's not impacted by monetary policy directly. Dividend paying stocks. In times of turmoil, there's a flight to quality. We want to own companies that have earnings, that have sales, that have pricing power, that have the ability to pass these inflated costs on to the consumer. And hopefully they pay dividends. So if we're going to take the risk and hold a stock through these type of volatile markets, we want to get paid for it. So that also helps us reduce downside risk. If we're getting 4% a year and the stock goes down 4%, we break even. So we're going to look for companies that have earnings, are established, are quality. Monetary policy, we think the market's priced in a lot of these interest rates, but again, we're going to be hyper vigilant on what the Fed does and how that impacts the overall market. Now, we think the market's priced these things in, but it can take a full business cycle for interest rate increases to really pass through. So we have to watch as that happens, as we go through another year, another business cycle, and we'll have to see where the Fed starts to toe the line. Again, that's a wild card, but we believe, sometime in the first half of this year, we should see rates level out, normalize, and kind of stay where they are for a while. I don't think we'll see them going down for, a couple of years, but again, we got to watch and see. I want to thank everybody for joining us today. And as always, if you have any questions, please feel free to reach out to me, Alex, or anyone else here at the Akers team. We are always happy to help, and we love talking to our clients.